ask people at the back to grab a seat. Can you hear me, Richard? Just making fun of me. We might just, if everyone can sort of grab a seat, that would be great, please. My name's Damien Wright. I'm the lead audit partner here at BDO, and I'd like to welcome you to this afternoon's event. We do this for our clients every year. This year there's a larger than normal presence in the room, and I think that is mainly due to all the change that we're experiencing in accounting standards. 3 new standards in particular that are having quite a large impact across corporate Australia and certainly across our client base. So Clark's been doing, as all the partners have been, lots of advice and some fairly complex technical issues around the new standards. The purpose of this afternoon is to give you an update on the changes that you'll see in terms of the new standards, plus a general update on some of the other changes through ASIC and the like. So just some quick background on Clark. He tells me he started in the profession in 1980 as an auditor, and so he's worked in audit for a number of years. But he's a full-time technical accounting partner, and is part of the BDO National IFRS group. So I'd like you to welcome Clark. Just some quick housekeeping. The bathrooms are just around the corner down the corridor. And following this evening's event, we're going to have some refreshments in the main foyer part of the building. But can you please welcome Clark in the usual way? Thank you.
Thank you, David. Evening, everyone. We've got a bit to cover in the next hour or so. As Damien said, there's some very significant changes in accounting standards. I'm sure you're all aware of that. I'm going to cover those 3 new standards in particular that we are probably all familiar with now. A bit of a recap and hopefully some pointers on things to watch out for in those new standards. And as Damien said, we'll cover off on a number of other topics which are probably forgotten about a bit at the moment because of the focus tends to be on the new WSB 9, 15, 16. Those things are going to have a big impact. In fact, what we're finding in our practice is that the standard that seems to be getting a lot of focus from clients is actually the leases standard, but and that doesn't apply this year. It applies next year, of course, for the first time. Very few people are early adopting that standard. In terms of the current year, WSB 9, the new financial instrument standard, and the new revenue standard do apply, and so we do need to take into account the new requirements of those standards in the June 19 financial statements. We've also going to cover just a few other standards that do apply June 19 for the first time. Fortunately for most of you, those things won't be too much of a problem, I suspect, because they tend to be on areas with limited impact. And then we'll just look at a few other things that are coming in the next 12 months as well. So if we just look initially at WSB 9, the new financial instrument standard, for many entities, it'll be probably out of the 3 new standards the one with the least impact. But at a minimum, I suggest that you do need to, or you should, go through your financial statements and update the financial statement templates as early as possible. Because a lot of the old jargon from the old accounting standard, up to 139, is now irrelevant. So, if you note 1 to the financial statements, if that's where your accounting policies are still disclosed, for example, we'll talk about available sale, financial assets and things like that. That's all now superseded. So can I suggest that at a minimum, you'll need to update the financial statements, templates, and insert the new wording for the new standard. In terms of the impact of WSB 9, we'll see a lot more fair value in the balance sheet than in the past. So some items that might have been accounted for at cost or amortised costs in the past will have to be accounted for at fair value. So that introduces some new issues for various entities, how to determine fair value. the impairment models changed quite significantly. We no longer have what's called an incurred loss model that we've historically had. We now have an expected loss model. And under that model, we'll be expecting to see the impairment losses recognised much earlier than in the past. It's also a lot more complicated than the superseded model out of the old standard. Hedge accounting is a bit easier, but for most of us, we don't hedge accounts, so that wouldn't affect many of you in the room. And there's some issues around transition that you want to look at closely as well. So just looking at the jargon, I'll just use that word if I can. In the old standard, we talked about loans and receivables, held to maturity assets, and available for sale assets. We no longer have those classifications. They've been superseded, and that's why I say we do need to update our financial statements, at least for wording changes. What we now have is these new categories based on measurement. Principally, fair value through profit and loss, which we're used to, amortised cost, that's a measurement basis, which is we've used historically for loans and receivables, and we have fair value through other comprehensive income for either debt or equity, depending on the circumstances. So we've got new classifications, particularly for financial assets. Now, in determining the classifications of the financial assets, there's new tests that have to be applied. And first one to note is the cash flow characteristics test. It's quite new. And basically what we need to do is assess whether the cash flows of our financial assets, the payments on those cash flows, satisfy what's referred to as the solid payments of principal and interest test, the SPPI test. If you meet that test, then you've got to consider the business model test, and that then determines your accounting basis and classification of your financial assets. If you fail the SPPI test, well, you drop down automatically in fair value through profit and loss. The thing to watch out for there in fair value through profit and loss is that there is a choice for equity instruments. You can account for them at fair value through profit and loss, or you can account for them at fair value through other comprehensive income, but you have that choice on initial recognition. It's irrevocable, so once you make it, you're stuck there. The difference between that and the old standard is when you sell those instruments, you don't recycle the gains and losses out of fair value through other comprehensive income, like you used to do for available sale instruments. They just stay, gains and losses stay in OCI. So those new tests need to be considered when we're looking at classification and accounting for financial assets. In terms of financial liabilities, the requirements are basically being carried forward the same as what used to be in AASB 139. There's a couple of minor changes which won't affect most of us. Now, just looking at the measurement issues in a little bit more detail in the SPPI test, first thing to be aware of there is when you're considering that test, payments to principal and interest are basically payments that satisfy what's referred to as a basic lending rate. So you need to be very careful about what's meant by interest. It's got to be interest that's consistent with a basic lending rate, is the concept. So if there's any elements of the interest that represents a return on the underlying asset that you've lent against, for example, say you'll get 5% interest plus 10% profit of the underlying asset, that won't satisfy that test. So you need to be very careful in analysing whether you meet the SPPI test. In terms of unlisted equity investments, historically, quite a few of those have been accounted for at cost, not at fair value. So when I say there's going to be a lot more fair value requirements in the balance sheet than in the past, that's a classic example of that. Unlisted equity investments. You no longer have the choice to account for them at cost. They have to be accounted for at fair value under this new standard. And the choice for equity investments, as I mentioned a moment ago, the important thing to note there is it's only for equity investments that are not held for trading. So if they're held for trading, short-term gains, for example, they are accounted for at fair value through profit and loss. You don't have that choice available. Now I mentioned that impairment is a significant change in this new standard. A couple of points to watch out for. For trade receivables, the new impairment model applies to trade receivables, so we would be expecting to see impairment losses recognised a lot earlier with our trade receivables than in the past under the old model. You may have heard that the expected loss model requires assessment of changes in credit risk between stages 1, 2 and 3 and such like. The standard does allow some practical expedience. So trade receivables would be a good example of that. The standard actually refers to a practical expedient using a provision matrix. So the simplest example I can give is that you look at your receivable based on ageing, and then you estimate the loss based on ageing, and calculate the provision based on that. That's fairly simple to do, and I would suggest that most of us in practice can actually do that, rather than have to go to the more complex methodologies that we might find in the standard. When we move to loans, however, we need to be careful with loans because the full expected loss model would apply to loans, whether that's be loans to related parties, for example, or loans to third parties. So that means we need to look closely at the changes in credit risk, because the model is driven by what stage in the life cycle the loan is in. It's based on staging of levels of staging. We have 3 stages, and that determines the measurement of your expected credit loss. It also impacts on disclosure. So those stages I just mentioned, there's 3 stages. The critical feature to watch out for there is assessing credit risk and changes in credit risk. So you'll need new systems around assessing credit risk and changes in credit risk, as well as probabilities of fault and how to calculate the expected credit loss. It's quite complex. I'll just mention this, we do have a fair bit of information available on the web for you. So we've got a number of publications there that deal with these issues, so feel free to have a look at those. As well, we have quite a fair bit of online training available for you on these matters, which we've just covered briefly this evening. So feel free to go online and look at that material. It helps you if you've got any detailed questions. Just looking at the new revenue standard, you've probably all heard that there's a new 5-step model being introduced within the new revenue standard. In practice, we do need to actually, in certain cases, get down to looking at each of those steps to assess how to account for revenue. In some cases, it's straightforward. You won't need to do much. If you're selling a widget out of a shop, it'll be pretty clear how to account for revenue in that case. But in many cases, you will need to go through the steps in the model to determine the appropriate accounting. For example, if you're in construction industry, if you're selling goods and services that represent multiple elements to the sale, you may need to go through these steps to determine how to account for your revenue. I've just got this slide up just to so that you appreciate that there's a lot of detail in the new revenue requirements. So basically, the old standards had about 77 pages, including the basis, inclusion, etc. These new standards have more than 4 times as much pages. So you can just simply see that there's a lot more detail. Unfortunately, it means we've all got, well, some of us have to actually go through that material, and sometimes it's not easy. So just looking at the steps and some of the new issues that we might have to deal with in the revenue standard. This is by far not meant to be comprehensive, what I'm going through here. I'm just pointing out some of the issues that we've seen in practice that we're having to deal with. So in the first step, identifying the contract, it deals with contract modifications. How do you deal with contract modifications? How do you identify them? there are a number of different ways to actually deal with contract modifications. One way is to treat the existing contract as terminated, as the start of a new contract. Another way may be to just treat the existing contract as continuing, but there's a revenue catch-up adjustment. So there are a number, depending on the nature of modification, that drives your accounting going forward. So if you're in an industry where you've got lots of contract modifications, this will have a significant impact, because your answer may be different depending on the nature of the modification. In terms of the second step, identifying performance obligations, that's probably, I certainly find this probably the hardest part in this new standard in some cases. You know, in many cases, you might just simply, your contract might be for one simple deliverable. Identifying performance obligations there may be relatively straightforward. But if you're providing multiple deliverables under one contract, identifying the individual performance obligations can be quite tricky and difficult. For example, do you have multiple performance obligations where you've got multiple goods and services you're providing, or should they all be bundled together and treated as one performance obligation? Because we account for revenue now for where we satisfy that performance obligation. Again, that's new jargon. And determining performance obligations is, I think, one of the hardest things to do in terms of complying with new standard in certain cases. The third step, dealing with the transaction price and measuring the transaction price, of course, where the transaction price is fixed, it's nice and simple. But in many cases, the transaction prices aren't fixed. There's variable elements to the transaction price. And where there's variable elements, that's where it gets tricky, because you've got to estimate the transaction price in that case. And the standard introduces a new concept, referred to as the reversal constraint. What that means is you can't recognise revenue unless it's highly probable there will not be a significant reversal. So some entities, for example, used to recognise performance fees as revenue as they went, even though the outcome of the performance fee wasn't determinable for some time into the future. In those cases, maybe those entities can't recognise those performance fees under the new standard as they did under the old standard, because they don't satisfy that reversal constraint. The new standard also talks about, in terms of variability, talks about the types of things that could cause variability in revenue. For example, penalties. You might have thought of having to pay a penalty for, say, being late on construction was an expense. This standard makes it clear that actually it's an element of revenue recognition. So that's a form of variability. So you might say, oh, I've got a fixed price contract for $10 million to construct X. And in that, there's liquidated damages if I'm late by a month or 2 months and it goes up the longer I'm late. Those liquidated damages actually mean that you have variable consideration. And you have to take that into account in estimating your transaction price. You can't just say it's 10 million. And whether or not that reversal constraint applies. So estimating the transaction price and the impacts of that reversal constraint are also a new complexity within this new standard. What we're finding in practice as well is there's new requirements in the standard about payments to customers. And probably in the last month or two, I've had at least 3 or 4 instances where this topic of payments to customers has come up. How do we treat and account for going forward payments to customers? Now, in the past, many of the entities that have payments to customers, and they treat those payments as an expense, marketing fees or something like that, or shelving fees if you're selling to Coles or Woolworths. Under this new standard, you've got to assess those payments to customers and only account for them as an expense if you're providing or you're receiving a distinct good or service. If you're not, those payments to customers are treated as a reduction of revenue. And some people don't like that. in the next step, there are some complexities around how you treat discounts. So where you have multiple performance obligations within one contract, and you've got a discount within that overall contract from your standalone selling prices of each of those performance obligations, does the discount get allocated across all the performance obligations, pro rata, or does the discount get allocated to one performance obligation only? That can be an issue under this new standard as well. It has requirements as to how you treat the discount. And then the last step, actually recognising the revenue, there are new tests as to that you have to consider in determining whether you recognise revenue over time or at a point in time. The old thinking has gone. We have 3 new tests that we have to consider. If you meet any of those tests, you recognise revenue over time. If you don't meet any of those tests, revenue is recognised at a point in time, when you transfer control of the good or service to the customer. That's an important change as well. The test under the old standard, WSB 118, was we recognise revenue when we pass a significant risk towards ownership. That's no longer the test. The test is now transferring control of the goods or services to the customer. And that can change the timing of revenue recognition. Those 3 tests are there. The first one, customer simultaneously receives and consumes the benefits provided by the vendor's performance. Simple example there is just the cleaning service that you receive or deliver. The second test is the vendor's performance creates or enhances an asset that the customer controls as the assets created or enhanced. A simple example there is a builder constructing a house on land owned by the customer. The third test is the vendor's performance does not create an asset with an alternative use to the vendor, so for example highly specialised assets that have been ordered by a customer, and the vendor has an enforceable right to payment for performance completed to date. Now the standard goes into a bit of detail in that, and that's not necessarily straightforward to assess. We're finding in some cases you actually have to consider the legal rights of the vendor in that case. And payment for performance completed to date is not just payment of damages. It's got to be actually something equivalent to the sales price of what you've already transferred in theory. There's also transition requirements you'll need to consider this year, because June 30 you're going to comply with this new standard. So how do you transition? Do you go to changing comparatives? It's probably a bit late now to be considering some of these issues, but if you haven't, do you change your comparatives? Or do you just change the current year and leave the comparatives as they were? That's the cumulative effect method. One thing to watch out for, if you are having changes this year and you are applying the cumulative effect method, is that you effectively have to run 2 books in the first year, because there's a disclosure requirement in the first year's financial statements to disclose the comparison of complying with the new standard with the old standard in the notice of the financial statements. So there's some level of comparability. The other thing to watch out for in terms of WSB 15 is there are significant enhanced disclosure requirements in this new standard. So again, I would be suggesting that you look at your template as early as possible, your financial statements template as early as possible, update the accounting policy notes, because there will be significant new disclosures there, because the old wording, the old references to the old accounting standard, for example, they all need to be taken out, and you need to put new wording in that reflects the requirements of the new standard. And you'll find if you look at this new standard, there is much greater disclosure around revenue. For example, we're having to disaggregate revenue a lot more than we historically have in the financial statements. There's a number of publications which are referred to on that slide. So again, They're available for you on our website, and there is a lot of material there as well on training on the new standard, on various steps in the new standard to help you if you have any issues. So highly recommend having a look at that material if you have an issue. So that's they're the two standards that apply this year. I suggest that we look at our financial statements templates and update them as soon as possible to comply with those new standards. Even if you haven't got an actual impact in terms of your balance sheet and P&L, you'll at least have significant disclosure changes. The LISA standard, as I said earlier, is the one which gets a lot of attention, and we're finding lots of questions from clients because in some cases there are major impacts of that new LISA standard. The key message under the LISA standard is that it affects lessees, not lessors. It does affect lessors at margin, but largely lessors are left alone. The big change is for lessees. The big change for lessees is that we no longer have operating leases. So, determining whether it's an operating lease or a finance lease from the perspective of a lessee, that issue's gone. Essentially, apart from a couple of exceptions I'll mention briefly in a few minutes, all leases are on balance sheet from a lessee's perspective. And what's the impact of that? Well, EBITDA is much higher. And that's a metric that some people place importance on, so some people like that. But obviously, profits will be lower in the earlier years than currently of a lease. And I've got an example to show you shortly on that. Statement of financial position, we'll have a new right of use asset on the balance sheet, whereas in the past we had nothing on the balance sheet for operating leases. We'll have higher debt because of the lease liabilities. And we have one impact is that we have current liabilities but no current assets to match as a result of this new standard. Cash flow statement gets affected as well, as you can see there. The impact, particularly on the statement of financial position, to be aware of and be thinking about is any impacts on your bank covenants or other contracts that may cause changes. For example, if you have a look at the impacts of the new standard, you might work out that you'll fail your bank covenants once you actually apply it. So you probably want to be modelling that and then talking to your bank to make sure you address that issue earlier rather than later. You'll also probably find that there'll be systems changes because you'll need new asset registers and the such like. So I've just got an example just to demonstrate the impacts of this new lease standard. It's just a nice simple example just to give you a picture of what the impact will be compared to the past. So we're just assuming that we're leasing a building for 5 years and the lease payments are $100,000 a year. Calculations there. I should say you'll get all these slides at the end, so you don't need to go through in any detail on the calculation. When we discount $100,000 per annum at the interest rate of 10%, which is probably the incremental borrowing rate, which the standard allows us to use, because it's a building, you won't know the interest rate implicit in the lease. We end up with a right of use asset and a liability up front of $379,000 because it's present value. And you'll do a calculation and you'll come out with an amortization schedule or something similar to this for both the liability and the asset. So I won't go through the detail there. You don't have time to do that. As I said, you will have these slides, so you'll be able to have a look at this later. But the important thing is to just understand the impact of this. So what we've done here is we're showing the impact of the old standard under 117. You just advertise or recognise the expense on a straight line basis, $100,000 a year. Under the new standard, we'll have a depreciation or amortization expense. That will be constant if you choose straight line amortization. As you can see, that's the green on the slide. Where there's a significant change is the interest expense, because over time, the liability decreases, so obviously the interest expense will decrease. So earlier on, the interest expense is higher, in the later years it's lower, and that's what causes a change in the expense profile. In terms of the balance sheet, under the old 117 there was nothing on the balance sheet, and now we'll have right of use asset and liabilities, they're grossed up, and we'll have a current liability, as I mentioned, and no matching current assets, so the current ratios look a bit different compared to the past. On day one, in this example, there's no impact on net equity. But over time, there is an impact on equity. In terms of the income statement, we can see there, making a couple of assumptions about revenue and other costs. EBITDA under the old standard, 300,000, under the new standard, it goes up. Because the expenses are pushed down below that line into amortisation and finance costs. As I mentioned earlier, there's also an impact on the cash flow statement because we push cash flows out of operating cash flows into financing cash flows. So operating cash flows look better. Again, that's a metric that some people use. So they all of a sudden look better, whereas financing cash flows look worse because we've got payments, at least we've got payments of the lease liability down to financing cash flows. The interest cash flows can be in either area of the financial or the statement of cash flows. It's a free choice under WSB 107. Of course, total cash flows don't change. Now, I did say that there's a couple of exceptions. So when I said all leases on balance sheet, well, it's all bar these exceptions. The two exceptions are leases of low value items. Now, the standard doesn't actually give any bright line on what's a low value item. In the basis for conclusions to the standard, it tells us that the ISB was thinking about items that, when new, cost about $5,000 US. I understand that there's the Treasury, for Queensland government purposes, has identified an amount of about $10,000 Australian as an example of below that as low value items. So low value items are an exception, and also short-term leases are an exception. So if you've got a lease of less than 12 months, including option periods, that's another exception. If you meet one of these exceptions, you don't have to put the lease on balance sheet. You can account for it similar to how you have in the past, and that's expense the rentals straight line over the term of the lease. There are some anti-avoidance provisions there to be aware of. So, for example, on the low value items, you can't take a car and split it up into various components and lease the individual components. The anti-avoidance provisions prevent you doing something like that. You know, lease the wheels, lease the engine, lease the body, lease the interior. You can't do that in 4 or 5 separate leases. That's how the anti-avoidance provisions work. Again, there are a number of choices on transition in this new standard that you should be aware of. You can apply the full retrospective method, which means going and changing the comparatives, or you can apply the modified retrospective method where you don't change the comparatives. That's a free choice. What's worth noting is under the modified method, there are actually 2 further choices. One of those, we've referred to there as approach 1, is you can set the right of use asset and the lease liability at the same value. So what you do is you calculate the lease liability based on the future payments at the appropriate discount rate, and then you set the asset to equal that amount. It's adjusted by any accrual or prepayments in the balance sheet. So effectively on day 1, under that choice, there is no effect on opening retained earnings. Whereas the approach 2 under this modified method, liability is set the same way, but the asset is calculated as if you've always applied the standard. So under this modified 2, the right of use asset will be lower than the liability. Highly unusual to be it's most likely to be below the value of the liability. Of course, the approach 1 is the simplest approach by far. So a lot of you might say, well, we'll take approach 1 because it's very simple. There is a catch. That is the effect on future profit and loss. So the first approach, the simple approach, results in the asset and liability basically being the same, whereas the second approach here, a much lower asset. What does that mean for future expenses? If the asset's much lower under this choice than the other choice, future expenses are going to be much lower because there's less depreciation. So this choice here will give you higher subsequent profits. So the catch is the simplest method will give you lower subsequent profits. The more detailed method will give you higher subsequent profits. And to some entities that will be important. So that's a catch to watch out for. So there's a fair bit of choice available on transition on the new leasing standard. Some questions to consider in transition to this new standard. For example, have you identified all your leases? Have you got all your lease contracts? We've dealt with a couple of clients where they're having problems finding all their lease contracts, for example. There's, I've mentioned the scope exemptions. Identify those items where you don't have to put them on the balance sheet. The lease term is an important issue in this new lease standard, because you're required to take into account option periods where it's reasonably certain that you will exercise them. So I heard one person a year or so back say that the new lease standard is just like treating everything like a finance lease as in the past. Well, it's not. Because under the old lease standard, cars, for example, might have been treated as finance leases on balance sheet, but buildings typically were not. And buildings, often when we're in buildings, there's option periods. So we really dealt with, having to how to treat option periods under the old finance lease standard. Whereas in this new standard, there's those extra complexities when we enter into building leases, for example, with option periods. It deals with that and tells us we have to take that option period into account if it's reasonably certain we're going to exercise it. Of course, if you say, oh, well, we will, and therefore we have to take into account, that means the right of use asset and lease liability will be higher. The new standard also deals with how to treat changes in payments such as CPI and market rental reviews. It tells us that we only take those changes into account in the future. We use the current payments as it is today when we're calculating the assets and liabilities today. So there's a lot more detail in the new standard dealing with things like that. And that's the variable payments considerations that you need to think about now. And discount rates are an issue, because you don't always know what the interest rate of the leases do. So you have to go and assess what your incremental borrowing rate is. And that's not always easy. There's other publications available there, which you mentioned, and also we have some further online training available for you on our website if you are interested in looking at that. So that's just a brief overview of those three new standards. They will have significant impacts on various entities. You'll at least have to change your disclosures in your financial statements to match those new standards. So I suggest that you look closely at your disclosures as early as possible to address that matter. Even if there's no actual change in your balance sheet and profit and loss statement this year net. So just looking at some specific Australian changes, Treasury amendments. Recently there's been a change in the law as to what is a large proprietary company or a small proprietary company. So basically the thresholds have been doubled. So that means next year, not this year, if you are between $25 and $50 million, for example, or 12.5 and 25, you may you may no longer meet the test to be a large proprietary company. So all thresholds have been doubled. So what that means, if you fall into the new definition of a small proprietary company, your reporting obligations have changed. You don't necessarily have to have an audit and lodge financial statements. Just a track to watch out for, a thing to watch out for certain proprietary companies though that are grandfathered. You may want to consider continuing to have an audit, because if you grow again, become a large proprietary company again, and you haven't continued the audits, you may all of a sudden find you have to start lodging. So just bear that in mind if you are a grandfathered entity. Tax rates have changed again for certain small companies. So what that means is that in calculating your tax balances, including current and deferred tax, you'll want to take those into account if you're within that small company tax rate change area. The SSB, they're still moving towards removing special purpose financial statements. They're not there yet. They've got a project on looking at that. We don't know if it's definite that special purpose financial statements will go. And what we're talking about is special purpose financial statements for lodgement with ASIC, ACNC and that sort of thing. So, yeah, they've got a project that we may see special purpose financial statements gone within a few years, but they're not gone yet. But what they have done is that they've put forward a proposal for some further disclosures in financial statements where you are preparing the special purpose financial statements. So the proposal is that if you have subsidiaries, you disclose whether you've prepared consolidated accounts, and if not, why not? And whether you comply with all the recognition and measurement requirements of the accounting standards. And if you haven't, give enough disclosure so it's clear what your policies are. And there's also some disclosure about investments and associates. That's actually not going to be in place on 30 June, likely be in place by December. And they are suggesting or voluntary disclosure in accordance with that, however. Corporate governance principles for listed entities, they've been updated further, so you'll want to have a look at those and address any further disclosures in your corporate governance statement. There's some other changes to the law around crowdfunding, such that small proprietary companies are able to raise funds through crowdfunding and remain as small proprietary companies. So that's a new change to the Corporations Act. And if a small proprietary company does take advantage of those new provisions in the law, they will have certain reporting requirements depending on the level of funds raised. They might have to prepare financial statements, have them more lodged, etc. In terms of ASIC focus areas, we don't know yet what they are for June 19, though based on history in recent times, we would expect them to be focusing on the impact of the new accounting standards this year and disclosures and compliance with those new accounting standards. I think that's a pretty well given that they will be focusing on those matters this June 30. Their other focus areas will be consistent, we suspect, with what they've been focusing on in the past, and in that list there, that shows what they're focused on. The two that are probably the more significant things we expect to see: impairment testing issues and disclosures. They've been on about that for many years, because they find many issues in impairment testing, and still, if we look at the changes in financial statements and ASIC coming out and commenting on changes in financial statements that they've driven, many of them are around impairment, where originally impairment wasn't applied with in their view. And the other area we're seeing they comment on a bit is revenue recognition. With the new complex standard, we can expect to see more of that. Just looking to other standards, we've already talked about 9 and 15. There are some other changes there, just to note. There's some changes to LSB 2. However, we don't think that they will be widely significant, so they probably won't affect most of you. There's some changes to WSB 128, which is the equity accounting standard, and also to WSB 140, the investment property standard. For 128, the changes relate to whether you measure your investments at fair value or use the equity method. And for the investment property standard, the changes relate to transfers in and out of investment property. The wording in the standard used to be restrictive in terms of when you could do a transfer in or out of investment property. They've changed the wording, they've given a couple more examples and made it clear that the examples they do have are not restrictive, they're just simply examples about when you can transfer in or out of investment property to other classifications such as property, plant, equipment or inventories. There's a new interpretation applicable this year to do with what exchange rate you use in terms of when you have advanced payment for the revenue transaction or expense or purchase transaction actually is recognised. And the easiest way to show how that works is just to show you an example. In the past there's been diversity in accounting for such transactions. So if we just look at a simple example, an entity that purchased a machine makes a payment on 1 April, the machine arrives a number of months later in September. We've got the exchange rates there that change between 1 April and September. And the question is, how should the entity account for those exchange rate changes in terms of purchasing a machine? In the past, different entities would have accounted for it different ways. This interpretation gives a nice, simple way to account for it. It says, at the date the payment's made, recognise the payment of the prepayment at the exchange rate at that date. That's common sense. That's what everyone would have done historically. It's the next bit that the interpretation tells us that's where the change is. You just simply use the same exchange rate when you recognise the machine. You don't change the exchange rate. In the past, different entities would have done different things there. Some would have done this, and others would have updated the exchange rate to the exchange rate at September and recognised the foreign exchange gain and loss. So this interpretation makes life a bit simpler. Hopefully gets more consistency. So looking at December 19 changes, and if you're preparing half-year financial statements for June, some of these things would be relevant to you. There's a number of further changes, obviously the leases standard, which we've been through already. There's a number of other changes to a number of other standards, most of which are relatively minor. And there's a new interpretation dealing with uncertainty over income tax treatments, which is a bit of a sleeper, can have some significant impacts. We'll cover that shortly. So just looking at WSB 128, that change simply makes it clear that where you have loans to associates, you don't just default to WSB 128 for the accounting for that loan. You, first of all, in considering accounting for that loan, you apply WSB 9, particularly considering impairment issues, and then you go to the WSB 128 requirements. Looking at the annual improvements, there's a number of annual improvements which are relatively limited in impact on most of us. So they're there in the slides. If they do impact you, we've noted it, but for most of us, they won't have much of an impact. So I won't go through those in detail. We will look at IFRIC 23 because this one is topical and can have some impacts for some entities. So what it deals with is when and how to apply the recognition measurement requirements of the tax standard where you have uncertainty in tax treatments. So sometimes, when you're trying to determine how to treat something, the tax law is uncertain, unclear, and you may take a particular position, but there may be uncertainty in that as to whether your position would be acceptable to the ATO if they conducted a tax audit. So that's what this interpretation deals with. And now a couple of examples there where you might have uncertainty if you have transfer pricing issues, research and development issues, There can be other areas where there's uncertainty as well. So this interpretation deals with that. And it tells us in particular the assumptions you're to make about the examination of tax treatments by tax authorities. Now, something that is probably a bit of a change for most of us in Australia is that we're not to assume that the ATO will not conduct an audit when we're determining our tax amounts. In fact, we're to assume the opposite. We're to assume the ATO will conduct a tax audit. And they will have full knowledge of all the facts and circumstances in respect of that area where there's some uncertain tax treatment. So you can't say, oh, they're not likely to come here, so therefore I'll count for it this particular way, and I won't. I'll just assume that this deduction is okay, or this revenue is not assessable, or whatever. You've got to assume that they will be aware of that and have knowledge of it. That can change. That assumption may change how you measure your tax balances. So what it tells us is that in determining the tax balance, we must reflect the uncertainty and determine the tax amount when it's not probable the ATO will accept our position. So that means that changes the measurement of the tax balances that we recognise in the financial statements. And more interestingly, there's disclosure requirements in this new interpretation. And I imagine lots of entities complying and telling the ATO, come and look at us, look at this particular area. So it tells us that we should consider disclosure of uncertain tax treatments in our significant judgments disclosures. Or, if we take a position that it's probable the tax authority will accept our position, we should disclose the contingency in a contingency note. Tax ATO, come and look at this tax position we've taken. We think we're okay, but come and have a look at our financial statements to see if you agree with us. That could be an issue for some entities, I would suggest. These issues have been in overseas jurisdictions, for particularly the US, for some years, but it's new for us in Australia. There's a number of other standard changes which don't affect us this year, just mentioned briefly. Insurance contracts, which will affect very few of us. Definition of a business, that changes going forward, and that could have a significant impact on accounting for business combinations going forward. So that's something to watch out for next year. And also the definition of material changes. There's new guidance in that area as well going forward. So that's just a high-level overview of the changes in financial statements that are going to impact us this year and in the next 12 months. There's a fair bit there. I suggest that we'll all be impacted in some way, at least in terms of disclosures in our financial statements and having to update our notes in our financial statements, at least for the new jargon, if not for other things. And for some of us, these changes will be very significant. So, at that point, does anyone have any questions? They're not too hard.
Thanks very much, Clark. So you'll get an email tomorrow, and included in the email will be a survey, and please can you just take a little bit of time and complete the survey and send it back to us. We use that information to enhance these presentations. You'll also get a link, a video link, if you want to send this presentation around to your colleagues at work, and references to all the technical material that Clark talked about tonight. So look, thanks again, Clark. That was a really good presentation. We're going to have some drinks in the foyer, as I said, so please everyone would like to just make their way through. Thank you.